I think silver could trade $100 an ounce by next year. I don't expect gold to make that large a percentage move, although I do expect gold to be above 5,000 next year. So both metals should still be purchased, but I still think that even with this move, you still want to make sure and be buying some silver along with your gold.
Deutsche Bank draws attention to their institutional clients who are also focused on accruing gold ounces. This feeds into the very sticky ETF demand that we've been drawing attention to, that is really forcing the insiders to short cover sold positions without anyone to rinse them into. Now, these are just a very few of many other bullish drivers at play.
A market doesn't usually announce when it's about to break, but silver is getting close to doing exactly that. The pressure that's built up under the surface is no longer subtle. Andrew Maguire's point is blunt. The short position is so oversized that covering it at current prices isn't possible. To pull enough physical metal into the system, you're talking about something in the area of $80 an ounce. That tells you how tight this market has become and how unrealistic the current paper structure is. Here's where the story gets even heavier. The Fed and the banks that helped suppress silver for years have run out of room to maneuver. Liquidity has cracked, and backwardation keeps flashing the same warning. This isn't a momentary dislocation. It's a sign that depth has evaporated, and the usual tricks aren't restoring balance. Gold is walking the same path. Roughly 39 tons have already drained from COMEX vaults, and even after stretching positions into February, about 128 tons of warrants remain open. Liquidity providers know what that means. More forced delivery through the EFP channel, more scrambling for physical, and more stress on a system that doesn't have much metal left to shuffle around. Meanwhile, ETF demand is behaving in a way it rarely has. These aren't quick-trigger traders. These are long-term allocations that force the insiders who sold unbacked derivatives to return to the market and buy real metal. The usual pool of weak hands simply isn't there anymore. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
We're talking a huge amount of a short position that is impossible to cover. Hence, the realization that to bring sufficient silver to market to actually meet this forced short covering demand is going to require a minimum of $80 an ounce. This is a huge misstep by the Fed. And with the Fed, their agent LPMCL, the four banks that have really managed to contain and act on behalf of them in silver, the liquidity, as demonstrated by backwardations, the liquidity has fractured. It's just not there anymore. Also, following 39 tons of COMEX gold deliveries so far already taken out of the vaults, net of rollovers into the February contract, there's still 128 tons of gold warrants still open. And liquidity providers expect large forced EFP deliveries. So let's take a quick look at some other supporting information that is of interest. UPS also continues to raise its 2026 forecast, 4,900, in sync with Goldman Sachs, JP Morgan, alongside almost every other bullion bank, looking at plus or minus $5,000 an ounce into 2026. We've looked at higher, but this is important information that's just really starting to put the naysayers in the rearview mirror. We've also got this Financial Times. And while we've been tracking the process of Beijing's secret monetary gold purchases, where we are not the only ones now assessing these aggregations are much closer to 80,000 tons as well, it's dawning on the mainstream media that assess China's unreported gold purchases could be more than 10 times its official figures. They're grossly underestimating this. This does not come close to capturing military gold purchases which are secret and literally hundreds of tons a year that escaped customs reporting. Beijing's happy with this. They've taken the gloves off. A rising gold price enables Beijing to challenge Trump and the dollar, and is a primary reason that gold's share of global reserves on a balance sheet has significantly surpassed US Treasuries. We looked at it last time, the type before. Now, while also acknowledged by mainstream media, gold's role as the only high-quality liquid asset, zero-counterparty risk investment asset, is grossly underestimated. This ECB post here is also it's beginning to dawn on Western commentators that the Bank of International sanctioned BRICS payment systems are one by one usurping SWIFT. This on the same week that the Bank of International Settlements backed Enbridge to BRICS trades was stealthily retested. Deutsche Bank, they report on inelastic gold demand, acknowledging that gold's demand is not just focused on a rising price in dollars, alongside long-standing evidence that central banks and sovereigns are diversifying fiat. In other words, they're just getting rid of their fiat into tons of physical gold. They're dumping their fiat into physical gold, regardless of a rising or a falling gold price. Deutsche Bank draws attention to their institutional clients who are also focused on accruing gold ounces. This feeds into the very sticky ETF demand that we've been drawing attention to, that is really forcing the insiders to short cover sold positions without anyone to rinse them into. Now, these are just a very few of many other bullish drivers at play. And the only question I have for you now is really, honestly, how much physical gold and silver do you own now before we look back at this opportunity window to take what is on offer while it's still on offer and to protect our wealth? That window is going to close soon.
Silver wasn't supposed to be the headline, yet here it is stealing the entire show. Peter Schiff lays it out with numbers that are hard to ignore. 6% in a single day. 13% in a week. Roughly 16.5% for November. And when you zoom out, the year-to-date move sits near 95%. With a full month still ahead, the metal is on track to finish the year almost doubled. That isn't noise. That's a market waking up. Gold is doing well too, up more than 6% in November and over 60% on the year, but silver is outrunning it by about 50%. What this really means is the leadership dynamic has flipped. For years gold was the engine and silver was the reluctant passenger. Now silver is the one pulling gold higher. That shift is usually what you see in a stronger, more mature bull cycle. The core message here is simple. Silver was mispriced for years, and this surge is it snapping back to something closer to reality. Even after a move this strong, the runway isn't gone. A move toward $100 next year isn't some wild fantasy. It fits the pace and the structural pressure underneath. Gold probably won't match silver's percentage gains, but a run past 5,000 is still entirely plausible. Let's get back to the interview.
I was watching March futures, and there the contract was trading well north of $57. So we're blowing through the high. The previous record high that we set about a month ago or so was around 54.40-ish. So we went right through that, through the 55 handle, and then through the 56 handle. Gold, not too shabby either, up better than $60. I think I just saw it up $65, trading at $4,220. It's not a new record high, but it's getting close, probably on a monthly basis, because this is the last day of November. And on a monthly basis, it probably is a new high for the month. In fact, it may even be a new high for the week. I'm pretty sure that it is. In fact, looking at how the precious metals have performed, silver up 6% today, which is, startling by itself. But It's up 13% on the week, 16.5% during the month of November. What a November to remember. But I think we may get an even more memorable December, because I think we're going to get a big follow through. Year to date, silver is now up 95%. Think about that. And the year isn't even over. We still have another month. So I think we're going to end up with a double in the price of silver in 2025. Gold up about 1.3% today. On the month, up more than 6%. And on the year, still up better than 60%. But silver is now outperforming gold year to date by about 50%. Now, this is something I have long been forecasting on my podcast and on these weekly market wraps. I've been saying that silver would eventually wake up from its slumber and take the lead and outperform gold. And that is exactly what it's doing. That's why I've been so bullish on silver, and I've been recommending that all of the Shift Gold customers buy silver too, not just gold. In fact, I've been recommending more silver than gold this year for the specific reason that silver was so cheap and you had a long way to go to catch up. Now, it's still cheap, clearly not as cheap as it was, but I think we have tremendous upside potential. I think silver could trade $100 an ounce by next year. I don't expect gold to make that large a percentage move, although I do expect gold to be above 5,000 next year. So both metals should still be purchased, but I still think that even with this move, you still want to make sure and be buying some silver along with your gold. And the fact that silver is now leading gold higher, this is very bullish. This means that the precious metals bull market is much stronger, because in the past, gold was leading silver. In fact, it was dragging silver, almost kicking and screaming like it didn't even want to go up. And that was one of the negative divergences in the precious metal space. People would be doubting the gold market because they weren't getting the confirmation from silver. Well, now we've got that and then some. We've got silver even stronger than gold. That's what you want. This new leg of the precious metals bull, which is being led by silver, is going to be even stronger. So gold is going to make even bigger gains now following silver than it did when it was leading silver.
Something bigger is taking shape beneath all the day-to-day volatility. Silver isn't behaving like a niche asset anymore. It's acting like a market that has discovered its limits and is now testing every weak point in the system. When a commodity starts forcing hedgers, vault operators, and liquidity desks into defensive positions, you're not looking at a routine upswing. You're watching a structure strain against itself. The size of the short pileup, the thinning inventories, the accelerating rally, and the widening gaps between paper and metal all point in the same direction. The old pricing framework is losing credibility. Gold is echoing that message, just in a slower rhythm. Physical demand is rising from players who rarely chase momentum, and the exit of weak hands has left a sturdier base than most analysts expected. Put together, these signals look less like a temporary squeeze and more like a repricing cycle that has been building for years. If silver continues to run ahead of gold while physical shortages intensify, the market narrative could shift from excitement to urgency. That's the kind of environment where prices overshoot because the system has no clean way to relieve pressure. With the walls tightening around both paper supply and physical stockpiles, how close are we to a moment when the precious metals market stops adjusting gradually and instead forces a sudden reset in how silver and gold are valued? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.